You're listening to Indications by the Conference Board.
Hello, my name is Ilaria Maselli, Senior Economist at the Conference Board, and it's a pleasure to welcome you to this edition of Indications Podcast, a series brought to you by the Conference Board. Today, I will be sitting down with my colleagues Klaas Vries and Hiba Itani to discuss some of the insights from our work of the last 10 days on the economic impact of the Ukraine crisis in Europe. We will try to answer questions like, how much do we expect inflation to increase in Europe? How are we revising our estimates for growth as a result of the Ukraine crisis? How high can oil prices go and why businesses should prepare for a logistics crisis? I wish we didn't have to record this podcast today, but here we are, with war sadly and unexpectedly coming to Europe. Hiba, Klaas, how are you today?
Thank you, Ilaria. I'm good. How are you?
Hey, Ilaria. Good to be here.
Thank you guys for being here today. I would say we start with Klaas. And Klaas, I would like to ask you how the European economy is entering into this crisis. So basically, what was in your outlook deck before February 24 when the Ukraine crisis started?
Sure. Well, I'll make it a bit broader also about global growth. So overall, our expectation was for global growth to slow a little bit from the rapid pace after seen after the pandemic recession. You had things like the fiscal support that was tapered. We had higher inflation coming up, especially in the US, and also resulting, monetary policy putting on the brake of growth, so to say. Shortages of labor, materials were coming up. We had slowing growth in China, so all this added up to sort of slowing global growth environment. At the same time, we were arguing there are some offsets. The Omicron drag was much smaller than we had expected, and it's already also fading. At the same time, in some economies, there was actually increased fiscal monetary support, primarily in China. Also, we saw some easing in some of the supply chain disruptions. For example, if you look at delivery times, that were starting to ease, overall in the last months. And, last but not least, we were counting on high savings by consumers to sort of also sort of cushion the actual slowing in growth. So all in all, in our base case scenario, before the crisis, we were still looking for a pretty healthy expansion in growth in this year, even though it was a bit slower than last year.
But we were still talking about, 4% in the euro area, right? And
Exactly.
almost
Yeah.
5% in the UK.
Yeah, well above longer term averages, indeed. Yeah.
Yeah, definitely. As we discussed the revisions to our economic forecast, I think the first variable we looked at was, of course, oil and gas prices. So I'm going to come to Hiba now and ask a bit the same question to you, Hiba. What were your estimates for oil prices for 2022 before the Ukraine crisis started?
Yeah, well, I have forecasted oil prices to average around $86 per barrel for 2022. And imagine I had a peak of $89 per barrel for the second quarter. So, and our biggest worry back then was supply shortages. Little did we know that, prices are going to jump.
Right. And just to put things in perspective, it's March 8th. We're recording this podcast. What was the oil price this morning?
$126. Yesterday it peaked at 139, almost hitting the 140, and now we're at 126, way past our expectations.
So where do we go from here?
Okay, so we've drafted so far, we have 4 or 5 scenarios that are possible. At the beginning, we thought a partial invasion was scenario 1 with possible sanctions imposed. But now, as Russia have almost completely invaded Ukraine, we have different sets of scenarios. So scenario 1, we have oil prices peaking at 105, with sanctions having limited impact on the markets and on Russia's progression. US and the EU continue to shield the oil market from politicizing it. This will create a minor and short spike in oil prices. The scenario 2, where we see oil prices peaking at 125, this is a more realistic scenario so far, as Russia intensifies its aggression on Ukraine, and we have the strict financial sanctions like limiting access to credit and SWIFT are imposed. And we expect prices to remain high for a longer period as the war extends. Scenario 3, prices hit 150. This is when intense military shelling jeopardizes the gas pipelines from Russia to Ukraine, and oil importers shy away from Russian oil because of worries about the credit restrictions and the energy sanctions. Here we expect OPEC plus intervention to remain limited as well, and the oil supply gap to widen. And finally, the scariest scenario is prices reaching $180. This is when we have an oil and gas embargo imposed on Russia, as the threats of use of nuclear weapons intensify. Definitely, we should see China taking advantage of this sanction to absorb some of the volume at a discounted price. The US and OECD oil exporters would then intervene extensively by increasing shale production and releasing barrels from their strategic reserves. OPEC and Iran as well will try to fill in the gap. However, the market will remain unbalanced for a certain time. As you see, none of those scenarios are remotely good scenarios. So we need to brace ourselves to a high oil price environment for the next couple of years.
Thank you, Hiba. That is quite clear. And what I found incredible is how fast the situation changed, because we started to imagine, the impossible scenario of oil price going to 150, and now we have to go even beyond that, only 2 weeks from the start of this discussion. I want to clarify one point. So sorry if I repeat that, but do you expect OPEC to increase production to offset some of the pressure?
Well, there are two answers to this question. Very good question, Ilaria. So on March 2nd, if I may go back, that was the first test for OPEC plus. So to define it, OPEC plus is the OPEC countries plus Russia and other non-OPEC members. So they have met back in March to announce their monthly addition of oil barrels. So given the mounting pressure from US and Europe, we expected some increases. However, the OPEC Plus decided to stick to the 0.4 million barrel per day increase for April. However, the group has been short on their target production for the last couple of months. So even the 400,000 barrel is hard to believe. And I think that even if they announce additional barrels to be pumped, I don't think this is a realistic number, and every month they are coming short of their target. My second answer to this will be no as well, but for a different reason. The OPEC countries will not increase their exports or their production because of their alliance with Russia over the US. So far, although everyone is trying to say that we're not going to politicize oil, I'm going to leave it to the political experts at TCB and other podcasts to answer this question.
And putting oil aside, I heard, I woke up this morning with the radio here in Brussels, putting the first piece of news was rising electricity prices. Can you tell us what is happening with gas?
Yeah, sure. So the invasion of Ukraine has led to sharp rises in gas prices in Europe and around the world. And this is mainly due to the worries about or concerns about possible curtailment of gas flows from Russia to Europe. Similarly to oil prices, I think gas futures reached 345 euros per megawatt yesterday, before sliding back to 255. A week ago, gas prices were around 150, and if you look a year back, it was 16 euros per megawatt. So prices are soaring. EU produces around 13% of its needs, while it imports through the pipelines from Russia around 67%, and 19% from NLGs. So we've started the year already at a low levels in terms of stocks, and with the potential disruption, it means that the current gas production levels will only last through the summer, and hence you see the spike in prices.
So basically, if I can recap, we import a lot of gas in Europe. We only produce 13% of what we need, you said.
Correct.
And because of the invasion, and actually already before the invasion in the last couple of months, gas prices were increasing from the record low of 16 euros per megawatt a year ago to all the way up
255.
to 255. Got it. Do you expect this mix of imports to change somehow?
Yes, definitely. Europe has to then diversify, because it proved that relying on one source is risky. Definitely, we will see a rise in LNG imports. If LNG, we definitely we're gonna see an LNG rerouting from the east or from the US to Europe. As well, they're gonna. We should see increased production from fields in the Netherlands and additional pipeline imports from Norway, North Africa, and Azerbaijan.
Thank you, Hiba. One last question for you on this chapter dedicated to oil and gas. Simple question. Can Europe survive without oil and gas from Russia?
Wow. Survive? Yes, I think so. But it's gonna go. It's gonna be really hard times. As I said again, diversification is mandatory. LNG, increased production and LNG is the only solution, in addition to greener sources. However, in the short run, there definitely gonna be a shortages in case of a full disruption from Russia.
And high prices, of course.
High prices, definitely.
All right, we're gonna take a short break, and we will come back with more on growth and inflation in just a minute.
Interested in more insights on the current Russian-Ukrainian crisis? Visit our geopolitics hub at conferenceboard.org/topics/geopolitics. Here you can find a range of easily accessible insights in the form of webcasts, podcasts, research briefs, and more. New resources are being added regularly to help you lead with confidence.
Welcome back. We're discussing the economic impact of the Ukraine crisis on the European economy. Klaas, I will go back to you now. Now that we have set the scene, I would like to ask you, what are the channels for the propagation of this shock? In other words, what are the key variables that we need to keep watching to understand the impact of the Ukraine crisis on the European economy?
Yeah, sure. Well, I mean, as Hiba explained already, it's mostly the commodity markets that we really need to watch. That is where Russia and Ukraine, play an outsized role in the global economy. And again, as Hiba explained, it's mostly energy is a very important component, particularly oil, natural gas, and the dependency on Russia and Europe is just very high at the moment. It has even increased over the last decade. So how can this feed through into the outlook? Well, first of all, you have higher prices for inputs that is leading firms to reduce production. For example, you can think of heavy energy users such as aluminium melters. I think already a couple of those have suggested that they are curtailing production because of these high prices. And then also from the consumer side, this is leading to a reduction in consumer spending power overall if you have higher prices. And then further, you could think of just reduction in confidence that could put a damper on both consumer spending, but also business investment. There will be a little bit more wait and see attitudes and more sort of holding off on making big plans for the moment. And I think finally for firms specifically, I think the additional worry is next to rising prices is also simply just shortages of key inputs. And that as I explained in the introduction, that before the crisis it was actually showing some signs of easing, also for European manufacturers. But now it's clearly that these shortages of materials, of these inputs, is going to become more problematic in the coming months, and that is further sort of limiting production.
And actually, you posted something on our Geopolitics Hub just yesterday where you talk about an upcoming logistics crisis in Europe. So there is a lot of supply chain issues that are emerging right now.
Yeah, yeah, no, it's not just stuff that is not coming here because of the sanctions, but it's also very things like truck drivers. Europe has become very dependent on, believe it or not, but a lot of Ukrainian truck drivers are on the European roads. There have been labor shortages in the transportation business for a long time. So it's there's a lot of factors that are sort of feeding into this. Now, just to be a little bit more on the positive side, what kind of things could, of course, all of this is on net, it's bad, but could we think of some offsets here? I think there could be. Perhaps in the short term, the most important possible offset is, again, as I also mentioned in the introduction, it's the savings, the amount of savings that consumers have built up over the last, year and a half, 2 years during the pandemic shutdown, when a lot of, spending, especially on services, was curtailed. So this is will be an important indicator to watch. How much of this deferred spending will by consumers will now sort of be used to cushion the impact a little bit, and of course also how fiscal policy support can also help. I know a lot of governments have already mentioned that they will sort of either put caps on prices or they will support lower incomes, things like that, to sort of dampen the impact of higher energy prices a little bit. And then finally, think a little bit more in the longer term. This is not something that will help in the short term, I think, is overall, things like investment in renewable energy is very likely to be ramped up. I think today the European Union is coming up with new proposals to really, speed up the investment in renewable energy. And also other things like defense expenditures. We had the announcement by the German government that they're uh, significantly increasing their defense budget. So these are things that again, this is not something that will help in the short term, but in the longer term, these could be things that offset some of these negative impacts.
Sure. And I know it's difficult because we are facing very high levels of uncertainty and we don't even know how long the crisis will last and how it will evolve. But Klaas, I have to ask you to give us some numbers for GDP growth. How are you revising the forecast?
Of course, yeah, I understand. We need to have some numbers around this. I would say we are still in the process of finalizing. It's probably today or tomorrow that we're finalizing. So by the time that this podcast comes out, I would suggest you check the Conference Board Global Economic Outlook page with the actual, the most recent numbers. We are looking for a downgrade to global growth in the range of I would say about 3 to 4 tenths of a percentage point. Now going from worse to smaller impact, obviously Russia and Ukraine are very likely to enter into recessionary territory, and next to that, The biggest impact is likely going to be in Europe because of the biggest exposure to these economies, as we explained. We're looking for Europe. We're looking for a hit of around 1 percentage point of growth. So before the crisis, we were looking for just under 4% growth this year, and now this is more likely to come in at around 3%. Of course, there are some differences across countries. It's probably going to have a bigger impact in Central and Eastern economies. Think of Germany and Poland. They are, first of all, closer to Russia, Ukraine. They're also more dependent on imports, but also finally they're a bit more industry oriented economies, and it's likely that the biggest impact is going to be in the industry, for all the reasons that we discussed so far.
So just to recap, basically we do not expect the Ukraine crisis to generate a recession in the global economy, and also we don't expect a recession in the euro area and in Europe as well, except of course for Russia and Ukraine themselves. Actually, despite this, growth is expected to be well above trend and well above what we saw before the pandemic. So something in the range of 3% is actually very high for European standards, even after this change in the forecast. Klaas, how does it compare to the US?
Yeah, so we think the impact on the US could be probably much smaller than what we see in Europe. We are looking at a downgrade, though, of I think in the range of 3 to 4 tenths of a percentage points. This is because overall the US is less reliant on Russian imports. Also think about energy exports in the US exceed imports, so it's a net energy exporter. However, overall, the US is more vulnerable, I would say, on the inflation front. Inflation has been higher in the US relative to Europe before the crisis already. So I think that is something where the US is going to see a big impact.
And yes, I want to go a little bit deeper into the inflation chapter, because when we started to analyze the revisions 10 days ago, what I thought was really interesting is how the impact on inflation of this crisis is actually even larger than the impact on growth. Am I correct, Klaas?
Yeah, yeah, and I think again, this comes back to the point that by sort of sheer economic weight, GDP or any other indicator you want to look at, Ukraine and Russia are not of sort of systemic importance to the global economy. However, they are key providers of a lot of commodities. So that is at the moment why we see these prices rising and likely to stay longer for elevated for a longer period than expected. And therefore we see a bigger impact on inflation.
So if I look at the numbers that we will publish later today, inflation could be higher than expected this year, something more like 1%, 1.5% in countries like France, Germany, and Italy, right?
Correct. Yeah. Yeah.
And do you expect the European Central Bank to react to that?
So my impression is that the ECB is in wait and see mode at the moment. So I wouldn't expect any new course of action until they have more of a more clear situation what's going on. It's as we already talked about, it's very fluid at the moment. Prices are really going up and down. I would say markets have so far at least seem to have pushed back some of their expectations on rate hikes for Europe. But again, there's no official communication on this as of yet to suggest a major change in their policy. Now, turning to the Bank of England, they are in a different position because they had already started to hike rates in last year in December, and they did another one in February. They were, planning to continue on that cycle this year. I think they will continue on this path, but they did signal that it might be a bit more gradual than they had thought about earlier.
Got it. Well, Hiba and Klaas, our time is up for today, and I would really like to thank you both for answering my difficult questions. And also a big thank you to you, our listeners, for staying with us. If you enjoyed this episode of Indications, please make sure you subscribe. You can do that with any major podcast application. One last recommendation from me today. For more resources on the fallout of the Ukraine crisis, I really encourage you to take a look at our Geopolitics Hub on the Conference Board website. We're posting 2 or 3 new pieces per day covering all aspects of the crisis, from human capital to corporate governance, from crisis management to supply chain. I'm Ilaria Maselli, and thank you for being with us today.
This has been Indications from the Conference Board.